Good morning and welcome to Charting the Markets on Monday, the 10th of July 2023. European equity markets started the week on a cautious footing, and that came about because of China's CPI data coming in unchanged for the month of June and basically reaching its lowest level since 2021, and also as Chinese factory gate price experienced the most significant decrease in 7.5 years. And this basically leads the Chinese policymakers to probably have to create a new stimulus package in order to boost its sluggish economy. And on the back of that, some Asian equity markets sold off overnight, which had a negative effect on European markets, which already last week saw a lot of risk-off sentiment as yields, for example, in the United Kingdom, continue to rise very sharply, with the two-year gilt yield now trading at levels last seen in July of 2007, so a 16-year high. So let's just begin by having a look at the FTSE 100, and we can see here last week's very sharp sell-off on this daily financial bet, taking us very close to the March low. And you remember that was made back when there was the mini banking crisis in the United States. And you can see here we came very close to that low on Friday by dropping to 7,228. Only 24 points above the 7,204 low seen back in March. And then this morning we tried to retest those lows, but actually bounced off them. So we're seeing some slight recovery here, but the technical picture still looks really, really bearish, short term at least. And it's not going to change unless, from a medium-term perspective, we were to rise back above the early July high at 7,562, and also the red line here, the 200-day simply moving average at 7,575. And as you can see, these levels are quite a long way away. So the odds are, despite the minor bounce we're seeing today, even if that were to continue over the next few days, we may actually stall once more and then retest these lows. And if we were to fall through the 7,204 low, taking us back to March of this year, then we would be heading back down again towards the October 2022 high at 7,104, and also the November 2022 low at 7,071. So these would be the next downside targets for the FTSE 100. But as you can see here, risk-off sentiment is clearly what is dominating this market at the moment. If you move on to the German market, what has happened here from a technical perspective is very interesting as well on the DAX 40 contract, because here you can see that last week we accelerated to the downside and fell through this key technical support area going back all the way to late April between 15,710 and 15,625. And we briefly slipped below that area to 15,455 on this daily financial bet, but then recovered and retested the upper range of that key support area, which now, because of inverse polarity, has become a resistance area and capped the upside on Friday. And we'll have to see whether today, as you can see here, the DAX 40 trying to regain its early morning losses, whether today we can again be capped by 15,710. If not, we could see a minor advance above this key resistance area now to perhaps 15,800 or so. But again, from a technical perspective, provided we stay below the last reaction high, that is to say the early July high at 16,211, further downside does look actually more likely than a new uptrend to be unfolding over the coming days and weeks. So what were to happen if we were to fall through 15,455? Well, the next downside target would then be the 22nd of March high at 15,305, and below there we also have the early March low at 15,144. These would be the downside targets, with perhaps even the 200-day simply moving average here in red at 14,965. So short term, yes, we're trying to hold. Medium term, it does look quite likely that we have formed a major top, at least for the summer months, and that we may come off in the next few days and weeks. Moving on to the US market, we can see here that the S&P 500 had some negative divergence because its high that was made in early July was marginally above that seen in June, yet the relative strength index was making a lower high, and that was alerting us to this possible reversal being seen, and this is actually now taking shape over the last week. You can see here the S&P 500 had declined, and that decline continued actually on Friday as the non-farm payrolls data came in weaker than expected, giving perhaps the Fed more room with regards to spacing out further rate hikes. And yet we still expect a rate hike to be seen by probably 25 basis points at the July meeting. But right now there seems to be still risk off sentiment on the S&P 500. I mean, overnight here we're trying to close our price gap with Friday's low at 4,397. We had some positive news out earlier this morning from China and in the tech sector about Alibaba Group and Tencent shares experienced quite nice rallies in Hong Kong, for example, on Monday morning. And this followed Friday's $984 million fine levied against Ant Group, which is an affiliate of Alibaba. And the company straight away announced a share buyback. And basically this move values the fintech company at a 75% discount compared to the valuation projected in a previously cancelled IPO plan, and provided basically liquidity and certainty to investors. And on the back of that, investors in Hong Kong seem to be thinking that the fine seems to imply the end of the regulatory crackdown on the tech sector in China, and therefore Alibaba Group and Tencent shares were rising. But that didn't really translate to the US market so far overnight, rallying very much. As you can see here, the S&P 500 remains quite weak, and that is probably on the back of rising rates, further money tightening being seen all over the globe, and this having a negative impact on the risk on sentiment in the short term. So if we were to fall through this morning's early morning overnight low, 4,378 on the S&P 500, the next downside target, and this is the critical level, is 4,328. That is to say the late June low. And if we were to fall through here, we would then be forming a top and could then slide all the way back down again towards this key sideways trading range, which we saw between April and early June of this year, around the 4,200 to 4,050 area. So that'll be really interesting to see whether we can hold at 4,328 if we were to retest that level in the next few days and weeks, or whether we just stay above that and continue our uptrend over the coming weeks as well. The US dollar was negatively impacted by Friday's weaker than expected non-farm payrolls data out of the United States. And basically the inverse of that can be seen on euro dollar, which very sharply shot higher. And you can see here we were trying to reach the late June high at 109.76, but stalled around there. And today we are still struggling a bit with that level. But if it were to be taken out, and if Friday's high at 109.73 were to be overcome, the next upside target would be the psychological 110 area, and also 110.12, the June high. So these are the upside targets for euro dollar in the short term. Supports coming in around the 3rd of July, so the early July high at 109.34. But basically, as long as that holds, further upside should be seen with regards to euro dollar on the back of that weaker greenback. And you can see the similar story with regards to cable, the British pound against the US dollar. This currency pair last Friday on that weaker non-farm payrolls data rallied back to the June high, made a marginally higher high on the daily financial bet here at 128.49, below which we are struggling today. But if that high were to be exceeded in the next few days, we could then be heading up again towards the psychological 130 area with regards to cable. And here the support short term comes in at Thursday's high at 127.81, and below there we also have the late June high at 127.16. So these are the possible short term support levels. But basically, provided we stay above the last reaction low here, that is to say the low from last Thursday at 126.74, the medium-term trend is still pointing towards higher levels for the British pound against the US dollar to be seen in the coming days and weeks. Moving on to the Japanese yen. I mean, what is interesting here is that the weakness in the Japanese yen has short-term at least stalled. And on the back of that weaker than expected reading with regards to non-farm payrolls out of the United States on Friday, and ahead of this Wednesday's US June CPI reading, the currency pair dollar yen basically has broken through its May to July uptrend line. And you can see here we have some acceleration to the downside on Friday on that non-farm payroll data, taking us down to 142.07. And if we were to flip through there today, then the next downside target would be the 20th of June low at 141.22. And below there, we've got the late May high at 140 yen and 93 cents. So these are the short-term downside targets for dollar yen. The actual uptrend would only be broken on a medium-term perspective if we were to slide below the June low at 138.44, but that at the moment looks pretty unlikely. When we look at the price of oil, WTI is kind of interesting because it has been rising for the last few weeks, and basically it did so as Saudi Arabia prolonged its voluntary 1 million barrels per day output cut until the end of August, and as Russia also cut its output by 500,000 barrels a day. And as you can see here on the daily financial bet, we have now managed to break through this May to July downtrend line and have actually overcome the late June high at $70.70 and nearly reached the early June high at $73.89. So this currently acts as resistance together with the May high at $74.70 on this daily financial bet. And basically, provided we stay there, we could still be trading in the sideways trading range we've been in basically since the beginning of May. But if we were to see further upside with regards to the price of crude oil on the back of worries to do with dwindling supply because of these OPEC plus output cuts, which together come to above 5 million barrels a day cuts, if you look at the whole of OPEC plus, in order to try and stabilize the oil price, and so far successfully doing so. If we were to see a rise above $74.70, the May high, we could then be heading up towards the red line here, the 200-day simple moving average at $77.22. So that is a possible upside target. It is targeted provided we stay above the last reaction low, that is to say a low which is lower than the one to the left and to the right with regards to its candles here, and that is to say last Thursday's low at $70.27. Provided we stay above there, the medium-term trend is pointing higher, especially now that we've broken out of this triangle formation and also above this May to July uptrend line. The price of gold is also interesting because if we look at gold, we last week tried to break through the May to July downtrend line, but had limited success. Intraday, we managed to do so on Friday on the back of weaker than expected non-farm payrolls data, but then came off again and closed actually below that resistance line. And today we are right on it. So from a technical perspective, for the bulls to be at least short-term back in control, what we need to see is a rise above Friday's high at $1,935 per troy ounce. In that case, we could be reintegrating the sideways trading range we saw for much of June, and that could potentially take us also back towards the orange line here, the 55-day simple moving average at $1,964, and also the low seen back in April at $1,970. So these are potential upside targets, but only if we were to rise above $1,935. If we stay below that high from last Friday, further sideways trading with a possible downside bias remains in play, and that could take us not just through last week's low at $1,903, but also towards the current, actually the June low at $1,894, and below that we have, as you can see here, the red line, the 200-day simply moving average at $1,848. So these are possible downside targets in case of a continuation of the downtrend being seen in the days ahead. But right now we're just trading in a sideways trading range, and what you need to do from a technical perspective is watch these key breakout points: $1,935 on the upside, $1,903 to $1,894 on the downside. Moving on to natural gas, the price of natural gas has declined over the last few weeks as the situation in Norway, which experienced some outages with regards to its gas exports to Europe over the last few weeks, seem to be resolved or getting to the stage where output can be increased again. Because don't forget that Norway has now tried to fill the gaps that Russia's gas exports to Europe were filling before the invasion of Ukraine by Russia. And Norway produced approximately 25% of Europe's needs last year with regards to natural gas. And obviously outages there do have an impact on the price of natural gas. And now that those outages seem to be resolving or getting towards a point where they're completely resolved, the price of natural gas is actually coming off again off its $2.93 high seen at the end of June. We have so far dipped down to last week's low at $2.53, and that is marginally above the 21st of June at $2.51. And if we were to fall through these two lows here, we would then have the orange line, the 55-day simple moving average at $2.47 in sight. So that is a possible downside target, provided we stay below the last reaction high, that is to say the 5th of July high at $2.79. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is AxelR_IG.